Hello, and thank you all for dialing in. I appreciate your time this morning. This is Kevin Carter speaking. I am going to be giving my first virtual CFA Society presentation, but certainly not my first CFA Society presentation. I'll ask for your patience if we have any glitches, but hopefully we won't. I want to thank Mark Salter for helping to organize this, and again, I want to thank you all for joining. So let me start first by telling you a little bit about myself and excuse me, how I came to be a speaker for your society. I live in the San Francisco Bay Area, where I'm currently under quarantine or shelter in place. And I live actually 15 miles east of San Francisco. I've lived and worked here my whole life and joined the investment business 28 years ago in 1992. And I'm going to tell you my story to help give you perspective on how I look at the world. And then I'm going to talk about emerging markets in some depth and make the case for one particular part of the emerging market story that I think investors ought to consider finding exposure to. So I graduated with a degree in economics from the University of Arizona and returned to the San Francisco Bay Area to join the workforce. And I had one interview when I started at a place called Robertson Stephens and Company, which at the time was sort of the premier West Coast investment bank. And the interview lasted 25 minutes. The first 20 minutes was a discussion about Pac-10 basketball. And then the person interviewing me, the president of the company, spent 3 minutes explaining the investment business to me, and then asked me if I could start on Monday. And I quickly responded, well, I don't know anything. How can I possibly start on Monday? And he said, well, go get this book. And he wrote down on a piece of paper, A Random Walk Down Wall Street. And I went and picked up that book on the way home, and I read it that weekend, and I showed up to work. Now, I don't know how many of you are familiar with the Random Walk Down Wall Street. I'm going to launch a little poll here, or attempt to, whereby you can answer that question if you're familiar with this book. It looks like there's 3 options. I've read it. Yes, I know it. No, I don't know it. Okay, great. This is working swell. So anyhow, I went home and I read this book. This is my copy of it. And I showed up Monday and started to work. And as I tell people, first and foremost, I pray towards Omaha. I am a Warren Buffett, Charlie Munger groupie. I attempt to think and look at all investment and business elements through what I have gleaned from what these two guys have done. And so that's the way I look at the world. Now, in 1998, as a young, somewhat naive value investor, in the fall of that year, I was shorting Amazon.com, and I lost about a third of my net worth in about a day, shorting Amazon.com. And I also that week, however, noticed something that occurred. A company called KTEL had changed its name to KTEL.com. And the stock went from $1 a share to over $30 a share in one day. And I said to myself, oh my goodness, I read about this. And sure enough, I went up to my bookshelf and I found my copy of A Random Walk Down Wall Street. And I found this page here in a chapter about stock valuations. And You can probably read it on your screen if you have your screen up. And you can see here a quote from Jack Dreyfus from the 1960s. Take a company called Shoelaces Incorporated and change the name to include the word silicon and electronics and earth burners. And lo and behold, the stock, PE of the stock goes up several fold. And I said to myself, oh my goodness, this is right out of the book. And I said to myself, I need to call this guy, the person that wrote this book named Bert Malkiel. And I used the search engine of the day to find him. He's a Princeton economist, some of you may know. And his Princeton bio came up, and it included his office hours and his class schedule and his phone number. And I dialed the phone, and surprisingly, he answered the phone. And I said, well, gee, Dr. Malkiel, you don't know me, but I read your book, and this just happened, and it's right out of your book. And he was nice and asked me to fax him some Bloomberg printouts about this company changing its name. And I did that, and that was it. And about a year later, I was attempting to start an online brokerage firm called e-investing, which transacted in dollar amounts rather than share amounts. So fractional share brokerage. You could buy $1.50 worth of Coca-Cola or $3 worth of Cisco, whatever you wanted, but you could do it without having to buy 100 shares and pay a $29.99 trade fee, which is about what trades went for back then. And I needed an advisory board to help me have some credibility and raise venture capital. And I called this guy, Bert Malkiel, back at Princeton and said, hey, Dr. Malkiel, I don't know if you remember me, but I have this idea and I think it's good for investors. And he said, that sounds like a good idea for investors, but I won't be on your advisory board unless I meet you first. You'll have to come out to Princeton to see me. And a couple of weeks later, I got on a plane east, and we had a 3-hour lunch, and we have now been working together since that day. So I guess now about 21 years. And we sold that company, e-investing. We sold it to E-Trade in the year 2000. We then started another company called Active Index Advisors. And Active Index Advisors was a pioneer in doing what is now called direct indexing. So indexing in a separately managed account that would allow for customization. If you were someone that wanted to leave up tobacco stocks or alcohol stocks, but it also allowed you to do loss harvesting and attempt to beat the index on an after-tax basis. So the active S&P 500 was the flagship of that company, and Burton joined me in starting the company and serving as the chief investment officer. And we built the business, and we sold it to the French firm Natixis in the fall of 2004. Natixis is a large holding company. They own Loomis Sales, the bond manager out of Boston, and they also own Chicago-based Oakmark funds, Harris. And we sold the company at the end of the year. The deal actually closed the first week of 2005. But a few months before that, Google had gone public. And when Google went public, they had an investor planning day beforehand for their employees, helping them understand what they should do with their money once they had it and how to invest. And the two people that were speakers at that were Bill Sharp, known for the Sharp ratio, and Bert Malkiel. And I was not involved in that presentation, but I heard about it. And early in 2005, my phone rang one day, and it was somebody at Google. And he had seen Burton's presentation and presumably had Googled up the name of our company, Active Index Advisors, and dialed me up and said, hey, I'm interested in investing in this active S&P 500 strategy. How do I do that? And I said, well, who's your advisor? He responded that he didn't have an advisor, and he didn't want an advisor. He wanted to just invest directly with us. And I said, well, I'll come meet you and tell you what we do, and maybe we can find a way to work together. And so I drove down to Mountain View one day from San Francisco. I sat down with this kid. I was a kid too, sort of, but he was younger than me, and he was 25. And I explained what we did, and he said, "Great, how much money should I invest in this active S&P 500 strategy?" And I said, "I don't know, how much money do you have?" And his response was, "I have $100 million." And I said, "Okay, well, that's good. And you're young, so you should be aggressive, but you're also rich already, so you should be conservative, and we'll call it moderate." And he said, "Great." And I said, maybe that's 20 or 25% in the S&P 500 strategy. And he said, what about the rest of the money? And I said, "Well, I don't do the rest of the money." And he said, "Well, what would you do?" And I said, "Well, I'd probably just buy a bunch of ETFs. I'd find the lowest cost piece of beta for each of the other pieces of the pie chart." And he said, "Great, can you do that for me?" So I became, in 2005, sort of the investment advisor to that individual, and then a handful of his other Google developer friends. And a few months after I got those relationships, my partner Burton wrote a paper about investing in China. Now, I had known he was he had taken a keen interest in China. I knew he'd been going back and forth to China with a couple of his Princeton economist colleagues who were Chinese nationals who had moved back to China to teach economics in Beijing. And the result of that back and forth was a paper making the case for China, which I had nothing to do with putting together. And soon after that, the people at Google called and said, "Can Burton give a talk about China down here in Mountain View?" And I said, "Sure, the next time he's in town, we can come down and do that." And we did that. And here's a picture of the flyer they had around the Google campus. And he gave his talk, and as soon as he was done, the main Google guy that I mentioned, the first guy to find me, looked at me and said, "I want to invest in China." And from the moment he said that to me 15 years ago until today, I have devoted my entire professional life to figuring out, what does that even mean and how do you do it? And I will now tell you what I have learned in those days, in those 15 years. So let me just give you some super high level stuff, and then I'm going to boil down everything I've learned into 2 bullet points, which I learned both of them on the first day involved in China and emerging markets. So first of all, emerging markets are the world. China's the biggest part, India is the second biggest part, but collectively, emerging markets are about 85% of the world's people. And we use the term emerging markets at our firm to include both emerging and frontier markets, also sometimes called the developing world. But this is the world. It's most of the world's people, and it's even more of the future as measured by people under the age of 30, young people, where emerging markets represent almost 90%. So emerging markets are not just the world, they are the future as well. Now, let me get towards the most important thing I learned in those 15 years. As you can see on the left, of this slide, emerging markets in the dark blue are now bigger than developed markets in the light blue. And on the right, you see 3 red arrows, and you can see the emerging markets share of certain categories. Again, at the top, population, most of the world's people. But down below, there's 2 other red arrows that represent consumption, retail sales and consumer spending, where they are way behind the developed world and way behind in their proportion of the world's population. And it's the delta between that top arrow and the 2 lower arrows that is the story. When you really peel it back, the story of emerging markets, the thing that is emerging are the people. There are billions of them, and they are moving on up. And as they move on up, they want stuff. They want more and better food, more and better clothing. They want appliances. They want vacations. They want cars, and they want their kids to go to Harvard. And that's the story. And I didn't have to figure this out. They told me when I got back to the office the first day. McKinsey and Company, as quoted here on the bottom of the slide, calls this the biggest growth opportunity in the history of capitalism. And as I like to kid, even if they're wrong and it's the second or third biggest growth opportunity in the history of capitalism, it seems like something investors ought to be aware of and perhaps focused on. Now, that's the good side. That's bullet point number one. Bullet point number two, I also learned on the first day. In fact, I learned it in the first 5 minutes when I got back to the office in San Francisco. So after the talk, we drove back up to our office in the financial district of San Francisco, went up to the office, and I asked the portfolio managers to give me a list of all of the companies in the iShares China ETF, ticker symbol FXI. I assumed that that was how we would get our China exposure for our Googlers that wanted to invest in China. Before they gave me the list, Burton said to me, look, when you look at the list, all of the top holdings are going to be Chinese government-owned banks and oil companies, state-owned enterprises, otherwise known as SOEs. And I said, yes, I've heard about this. That doesn't seem like a good thing to me. Right? I've been to state-run operations like the Department of Motor Vehicles, and they don't strike me as being the most efficient types of businesses. And he said, yes, they're not very efficient, and they also have a lot of conflicts of interest, and they have poor corporate governance. And he gave me an example. He said, look, you've got a Chinese state-owned manufacturing plant making widgets. It employs 15,000 people. It's been losing money for decades. It needs more money. It goes across town to the Chinese state-owned bank and says, hey, we need more money. The banker doesn't say, no, you didn't pay us back the last money. The banker says, we can't have 15,000 people out in the streets protesting, so we'll give you more money. And that made me literally nauseous, because in my Omaha brain, earnings equals value, and growth of earnings equals growth of value. And if the people in charge of these companies don't care about that, what's the point? And in the case of the China index, particularly back then, it was about 85% Chinese government-owned banks and oil companies, and a couple or three phone companies. And it had very little exposure to the consumer, less than 10%. And if you look at the broader emerging market indexes today, the MSCI-based funds like EEM and VWO, or VWO rather is a Vanguard fund. If you look at those funds, they're about 30%, or in fact a little more than 30%, in state-owned enterprises. And these are problemed businesses. These are not really for-profit operations, at least not for your profit operations. And the poster child for this now is Petrobras. I'm sure that most, if not all of you, have at least seen the headlines about what's happened in Brazil in the last decade. Essentially, the elite of the country, the government officials, the corporate leaders, the bankers, were all involved in various schemes to defraud the enormous state-owned oil company Petrobras for their own riches. And in fact, now there are two former Brazilian presidents that are in jail for stealing money, essentially from the shareholders of EEM and VWO and other people that have investments in Petrobras. So this is a problem, and I didn't have to figure it out. It showed up on the first day, and it's simply become crystal clear to me over the last 15 years. And it's actually a little bit worse even. It's about 33% state-owned enterprises. But if you added two other groups that have a lot of the same problems, it comes to almost 50% of the index. You have the Russian oligarchs that took control of the Soviet state-owned enterprises, and you have the Korean chaebol, and these companies have a lot of the same conflicts and problems. Some of you may know that in Korea, you had a scandal whereby the chairman of Samsung, who's being mocked here by some protesters, a mask of him, he went to jail for bribing the woman whose face is depicted on the mask to the right. That's the former president of Korea, who was impeached. So it's not just a China problem. It's not just a Brazil problem. It's not just SOEs. It's some of these other legacy types of businesses like the chaebol and the oligarchs that are collectively part of what I think makes traditional indexing in emerging markets a bad idea. Now, let me get back to this story, because really this is the positive part of the story, and really what I've tried to focus on. If I was to describe what I've tried to do for the last 15 years, it's been to minimize the exposure to the legacy economy, to the corruption and the state-owned part of the economies, and increase exposure to this story. And in the first 10 years on the indexing and ETF side, we partnered with Guggenheim to launch a number of China ETFs. And eventually people that knew me would sometimes ask me, they knew what I did, and they'd ask me, what's the best emerging markets ETF to buy? And I had come to conclude that the best emerging markets ETF to buy was the one that matched to this slide, an ETF with the ticker symbol ECON, Econ, the Emerging Market Consumer ETF. Now, that was not a fund that I was involved with in any way. I didn't work for the company that made it. I didn't even know anybody at the company that made it. I just knew that it existed, and it matched this slide. The title of the fund was the same as this. And that was my go-to answer for people when they asked about the best emerging markets ETF to buy. 6 years ago, I had decided, I looked in the mirror and said, you know what, I got hooked up with this indexing guy at Princeton, and it's been fun, and China's super interesting to me, but I gotta go back to my roots. I need to focus on my wannabe Warren Buffett approach to investing. And I told the Guggenheim people that I was going to tone down my efforts with them and focus on setting up my own operation. And I did that. And I set up an investment partnership for myself, and I bought 5 stocks. And I was going to go around town one day to see if any of my friends or investor relationships had an interest in investing in this partnership. But before I went to see them, I made a few slides to show them. One of the slides was a list of the 5 companies that I had purchased in the partnership. The first 3 of those companies were companies that were in the emerging market consumer ETF. The first one, trading in Hong Kong, called Want, W-A-N-T, twice, Want. This is a snack food maker. This is the quote-unquote Nabisco of China. Crackers, cookies, juice boxes. The next 2 companies, both of which were also in the emerging market consumer ETF, also trading in Hong Kong. Li Ning and Peak Sports. These are 2 Chinese sportswear companies. We can't call them the Nike of China because Nike is the Nike of China, but to make it simple, you can think of them as the Puma and Reebok of China. So those were the first 3 companies, food and clothing, all 3 of them in the emerging market consumer ETF. But I also owned 2 other companies, but they were not in the emerging market consumer ETF, so I put them in a separate column. They were called technology companies. The first one trades on the New York Stock Exchange with the ticker symbol WUBA, W-U-B-A. WUBA. This is the Craigslist of China. And the last company trading on the NASDAQ, MELI, Mercado Libre. Mercado Libre is the Amazon.com and the PayPal of Brazil and Mexico and every country between those two. This is the emerging America's leader in e-commerce. And that was it. Those were the 5 stocks. And I looked at the slide when I was done with it. And I thought, you know, all 5 of these are part of the emerging market consumer story. The 3 that are in the emerging market consumer ETF, I think they're great. I think they have moats in form of brand equity. They're growing at 15 to 20% as they participate in this consumer story. And the CEO is the founder. He owns the same share class as me, so he cares about shareholder value. So I felt very good with those companies. But then when I considered the 2 other companies that were not part of the emerging market consumer index and ETF, I looked at them and I thought these companies are growing at 100% plus in the case of WUBA. And in the case of WUBA, it also had a 94% gross margin. Now, if any of you are Warren Buffett people and think about moats, I always look at the gross margin first when I want to see if there's a moat. And I had never seen before or since then a company with a 94% gross margin. And I just thought to myself, you know, all 5 of these companies are part of this story. The ones on the left that are part of the ETF are great. The ones on the right are growing 7 times as fast and are also great. And maybe they're even better. And that was it. I thought that. I printed the slides. I got in my car. I drove around town to 3 different meetings. I got 3 checks. I'm on my way home. I stop at a stoplight and my phone rings. And it's a friend of mine with a 3-year-old daughter. And she asks me, what's the best emerging markets ETF to buy for my daughter's college fund? I started to tell her what I told everybody else before that, which was to buy the emerging market consumer ETF. But I stopped myself and I had a light bulb moment and I drove home and immediately began to assemble EMQQ, and it launched on the New York Stock Exchange 100 days later. And what I realized at the time, and I saw it in the growth rates, but and my thoughts have obviously crystallized over the last 6 years since I began working on this. What's happening is a combination of 3 mega trends are coming together at the same time in a great confluence of growth. The first of those 3 trends is this one, the emerging market consumer. But this mega trend is meeting up with a couple of others. The computer. Now, I've had a computer for a long time. I've had a computer for 30 plus years. I even had the silly looking white one with the floppy disks on this slide. The smartphone is a computer, and it's a pretty new computer. 6 years ago, when I had the idea for this, I hadn't even had a smartphone for 4 years yet, but I was watching how it was changing my own family's consumption. As I mentioned, I live east of San Francisco. 6 years ago, my family was going to this store 4 times a week, 5 times a week. It was easy to go to the store. It's 3 miles from my house. The roads are paved. There's free parking. But all of a sudden, I noticed a shift. This started to happen once a week, and then twice a week. Now, my family goes here once a month, and this happens 20 times a week, maybe more in the coming weeks. And so if you think about how this smartphone has changed our consumption, and you map it over to this, Well, that's where the story gets really big. Most of the world has never had a computer before, and most of the world will not have a computer like the ones that you are probably looking at and I am looking at right now. The smartphone is bringing the computer to the world, and it's happening very fast. And it's not happening on Apple. So 90% of this is $50, $60, $80 smartphones running on Android, made by Xiaomi, Vivo, Oppo, Huawei. This is the second story, second mega trend in the story, the computer. And the final part of the story, the third key element, is called the internet. Again, just as we've had computers for a long time, we've had the internet for a long time. I've had the internet since at least 1995. We used to get it via telephone line. Then we got it through the cable. Then they gave us a box to put next to the cable box so we could sit on the couch with our fold-up computer. Now it just shows up in our pockets, whether we're on a train or a plane or a car, and we take it for granted. Most of the world has never had the internet until they get their Android-based smartphone. And you can see from this slide that it's very early. I think most of you have already been sent these slides, and it's also available on this platform as a handout. I think on the lower right, at least on my screen, you can see it there. But if you don't have these slides and you want them, just reach out to the organizers and we'll get them to you. But what this shows you in green are the emerging markets. The two biggest ones, of course, China and India. The white space and the number at the top represents people in those countries that don't have a smartphone. And if you added up all the white space, it's about 2 billion people. And if you're in Western China or India or Africa and you don't have a smartphone, there's a 100% chance that you also don't have a MacBook Pro. So the world is just now getting the internet. So you're combining those three mega trends, and these billions of people around the world are becoming consumers as so-called digital natives. And the result is this. This is the most important slide in this presentation. It is literally and figuratively the money slide. What this is showing you is in blue, the revenue for the sector, and in green, the growth rate for the year. Now, when we say sector, we're talking about all of the companies that are part of our index that the EMQQ ETF is based on. There are 77 publicly traded emerging and frontier market internet companies in EMQQ, and this is what they have done in the last decade. As you can see in the title, this is a compounded annual growth rate of 38.5%. Now, I'm not 100% sure about anything in the world, but I am 99.5% sure that this is the fastest growing sector in the world, and I'm equally sure that it is the fastest growing sector of publicly traded companies ever over a 10-year period. Now, I could be wrong. I've asked a lot of people. I've asked 35 or 40 CFA societies like the one that's on the phone here today, and nobody has challenged this. When I first gave this talk, if you just looked at the left hand of the blue bars and you look at the 2014 number, I gave my first CFA presentation in San Francisco a little over 5 years ago. And I offered the people in the audience a ham sandwich if they could find me a sector that had never grown like the numbers you see from 2010 to 2014. People chuckled, whatever. I gave another 6 or 8 or 10 CFA society presentations in the coming few years, and I decided I would raise my offer to make it more serious. And in Hawaii, a few years ago was the first time I offered a cash reward. I said, if you can find me a sector that's ever grown this fast, I'll give you $10,000. Now, I tell people, if you can find me a sector that's grown this fast for this long, I'll give you $100,000. And I've still never had a challenge. Now that we have some real dollars on the line, we do have some rules about this challenge. It's got to be a full sector. There's got to be 20 plus companies, minimum size, et cetera. They've got to be public. But nonetheless, I am very confident that this is the fastest growing sector in the world today. And I also am confident it is the fastest growing sector ever. It's hard for any company to grow at 38.5%, let alone this whole sector. And it's explained by the fact that you have all these consumers coming online for the first time and leapfrogging traditional consumption, which we'll talk about a little more. So now, while investors have complained about the performance of emerging markets broadly, which is depicted here in yellow at the bottom, that's the EEM, that's the iShares ETF that tracks the MSCI Emerging Markets Index. It hasn't done much. In fact, it's back down into the red now after the last few weeks. In the blue line, you can see the internet companies, and you can see they've done quite well. So yes, it has been a lost decade for investors in emerging markets, but it hasn't been for those investing in the internet space. So result one of this combination of great mega trends is massive growth. Result two is value creation. Now, these are the lines as of 12/31/19. Rather, it looks like the title says Valentine's Day of this year. But yes, if we updated this chart today, there'd be a lot of decline recently on both lines. But nonetheless, so now let's talk about some of the companies. Alibaba everybody knows this company. It was the largest IPO in U.S. history. The story that I've been telling you has been sort of right in our face. The biggest IPO in U.S. history was a Chinese internet company. And let me make an important point while we're talking about Alibaba. Most of these companies are started by local entrepreneurs, but they're funded by U.S. institutional investors. And the reason that is important is that corporate governance is the biggest problem in emerging markets. These companies have very good corporate governance. And that's why most of them list on the New York Stock Exchange or the NASDAQ, because those are the exchanges in the world that have the highest listing standards, the most transparency, the highest accounting standards. And it's the Ivy League endowments, it's Harvard and Stanford investing through a Silicon Valley fund, or in these two situations, U.S. corporate investors. Yahoo made $1 billion investment in Alibaba that turned out to be worth a lot more and was almost the only thing they had of value at the end. And in my favorite story from 2019, this company on the lower right, StoneCo, this is a Brazilian fintech company that went public on the NASDAQ, and Berkshire Hathaway, my heroes, actually bought 6% of the company on the IPO. I believe the first time they've ever invested in an IPO. So corporate governance is really good, and that's why you'll find most of these companies trading on our exchanges like Alibaba. Now, one company that I'm sure some of you know, but perhaps not all of you, is almost as big as Alibaba. It's called Tencent. It's not as well known because it trades in Hong Kong. Didn't come public with as much fanfare as Alibaba. Tencent is, as we say, it's the Facebook of China. They have an app called WeChat that is the social network. And so it's fair to call Tencent the Facebook of China. However, Alibaba and Tencent, neither of these companies really have a U.S. equivalent. And the reason is this: because in the developing world, the consumption infrastructure has not been built out, i.e., bank accounts. There are not bank accounts the way we have them. There are no televisions on the wall with 1,000 stations coming in. There may not be a Walmart or a Target store. Because there is such limited consumption infrastructure, It's allowing Alibaba and Tencent, each of whom have about 1 billion users, to go into verticals that their US counterparts cannot go into as easily and digitize many elements of their economies. Where this is showing up right now, by far, in the streets and in the income statements is fintech. The world is leapfrogging us in terms of digitizing their financial systems. This is a photo I took from my last trip to China, the city of Nanjing. And in any Chinese city, in the mornings, you'll see people coming in from the countryside with eggs or produce to sell. They'll set up in the alleys and on the sidewalks. And every place in China that you would like to spend money, you will find the 2 QR codes in this picture to the left of the bananas in the foreground. The green one, WeChat Pay, the blue one, Alipay. Everywhere in China that you wish to spend money, you will find those 2 QR codes. People selling dumplings on the corner, people selling fruit, even the beggars have QR codes on their cardboard. That is not a flippant comment, that is a true thing. So this particular trip was the first time I tried to spend cash to acquire something. The same day I took this photo, we were down below this street in the subway station trying to get across town, and I tried to buy a bottle of water at the newsstand with cash, and they would not give me the bottle of water. They said I could not buy a bottle of water with a Chinese banknote. Meanwhile, up on the street, they would gladly sell me pigeons with my phone. So this is important because once you have the wallet, once you have the money, there's lots of other ways for these companies to make a profit. Now, for example, Alibaba now has the largest money market fund in the world. Some of you may have seen that earlier this year, Alibaba launched a Chinese partnership with Vanguard to bring a digital wealth management platform to China. Alibaba and Tencent also co-founded an insurance company called Zhong'an, which think of it as the Geico of China. It has since gone public in Hong Kong, and it is also now part of EMQQ. So fintech is a very big part of the story as the developing world leapfrogs us. And you would think that I would be one of the earliest adopters of mobile payments. I should be the person that walks around like George Jetson, zapping my phone. I'm a fintech entrepreneur. I live, like I said, here in the San Francisco Bay Area, and it's quite a paradox that I am, relative to the rest of the world, I'm pretty far behind on mobile payments, and indeed Africa has some of the countries with the highest penetration. I believe Kenya's GDP is close to 85% phone-based. So leapfrogging in fintech, and it's showing up in the numbers. Let me just give you a few examples of some of the other geographies besides China. Mercado Libre, we talked about, one of the companies that inspired EMQQ to be created. This company was started by a Stanford grad student while he was at Stanford. Again, it's the leader in both payments and commerce, e-commerce in every country south of our border, including places like Nicaragua and Costa Rica that aren't even considered frontier markets yet. And in terms of corporate governance, Michael Spence, the Stanford Nobel Prize-winning economist, an early board member, eBay, a 20% strategic shareholder early on. So corporate governance is very good. If you look at the fact sheets or the country allocations to our operation, you'll see Argentina sometimes has a pretty big weight in this company. The headquarters are in Argentina. Brazil is by far the biggest piece of revenue for it. So Mercado Libre, example of the emerging Americas. Eastern Europe, Yandex, this is the Google of Russia. It trades here on the NASDAQ, and it's also become the Uber of Russia. When Uber and Lyft appeared in the world, people copied it. In Eastern Europe, it was pretty easy for Yandex to take the lead. They were, again, already the Google of Russia. And Uber did go to Russia to compete, but they quit and they retreated. And as they retreated, they went to Yandex and said, "Hey, can we have some stock if we give you what we built?" So San Francisco-based Uber is now a minority shareholder of Yandex Taxi, and Yandex Taxi would have likely IPO this year, and maybe it still will, but I think before coronavirus hit, it was moving fast to do that. So Yandex, an example of the Eastern European version of e-commerce. We wish there was more publicly traded Indian companies. There are lots and lots of big unicorns in India, but there's a handful of public companies. This is the leading travel app, Make My Trip, trading on the NASDAQ. And finally, Africa, Jumia. Jumia is a Nigerian e-commerce leader that went public on the New York Stock Exchange in 2019. It is in 10 different sub-Saharan African countries, including Nigeria, its home. Now, this is the most volatile stock I have ever known in my life. And I'm not certainly suggesting any of these individual companies for purchase. I'm simply pointing out that this is that e-commerce and the things we see in our lives are happening all over the world. This company came public at, I think, $16 a share. And I remember when they came public, a reporter called me and asked me how I thought the thing was going to do on the IPO. And she was really fixated by the fact that they were losing money. And I pointed out to her that the richest man in the world had his own rocket ships, and he lost money for 20 years. And I lost a lot of my money betting against him. And that you can go public when you're losing money. And I said, they may not matter as much as your article headline. You're probably going to call it the Amazon.com of Africa, and people are going to get excited about that. And sure enough, the stock priced in the teens. It went to, I think, 50, and now it's selling for $2 or $3 a share. So this particular company, if you like the stock market activity for the last couple of weeks on the volatility, you can always find that in Jumia with or without coronavirus. So now let me just make one other point about the companies. Inside of the 77 public companies are equity investments in over 300 private companies. Alibaba and Tencent are now amongst the largest venture investors in the world. This is one of their investments. This is a company called Didi. This is the Uber of China. And we like to point it out because we talk to a lot of advisors, and as we tell advisors, you're going to hear about this company when it comes public, and there's a good chance that your clients, at least one of them, is going to call you and say, "Hey, I just saw this woman on TV." When ride-hailing showed up in the U.S., people copied it, as I mentioned. In China, there was two early companies, Didi-A and Quad-I-A. One was backed by Alibaba, the other one backed by Tencent. When Uber announced that they were going to go to China, Alibaba and Tencent simply merged their apps to form a single company called Didi. Uber, as they did in Russia, realized it couldn't compete with the locals, and they quit and traded their business to Didi for some stock. And the reason we tell advisors you're going to hear about this company is because when it comes public, it will probably do so in the U.S., and this woman will be on TV, Jean Liu, and she's quite an impressive woman, and she's very articulate. But it's not just that, the story's better. I am a early adopter and power user of Uber. I use it all the time. If I had made it to Minnesota for this presentation, I would have certainly arrived at either my hotel or this presentation, or both via Uber. And I also use Uber when people invite me across town to have cocktails or wine, and I don't want to drive home. I have a car. Why, when this woman speaks, not only is she articulate, but she's going to explain that in the developing world, people use ride-hailing because they don't have a car and they don't know anybody with a car. So again, the pain points that are solved by these businesses are even greater than the luxury that they provide us. So in summary, this is a growth story. It's explained by this combination of three mega trends at one time, and the leapfrogging that's going on in the developing world, and that is why these companies are growing as fast as they are. Important side benefits: in a part of the world where corporate governance is your biggest enemy, you actually get very good corporate governance, which is why these companies trade on our exchanges. And finally, you get a lot of exposure to companies like Didi that are not even public yet, but are in many cases valued in the tens of billions of dollars, if not even more. So that's the fundamental story. Now let's talk about, okay, fine, now there's something to buy. Well, our world here at EMQQ has been quite exciting for the last couple of years. First, we had a trade war. Then that resolved itself, and then now we have coronavirus. So let me just kind of review how things have gone for investors. So you look on the bottom in green, you can see the revenue growth of the story has been fine. This is the fundamental story intact, 30% plus growth. If you see the two red arrows in the top here, that's when the trade war started. So we had a pretty good run in 2017. 2018, we lost about a third as the fears of the trade war and tariffs hit the marketplace. Last year, you can see we had a really good start up until May 3rd. Then we walked away from the negotiating tables with the Chinese and gave most of that back. And then in the fourth quarter, we went on a tear. Now, we've since given back quite a bit of that, and we'll make sure to make the most updated slides available. But things were looking pretty good. We told people the trade war, we didn't believe it would happen, and that either way, we were not involved. And EMQQ was not something that was part of the trade war. The trade war is about agricultural products and manufactured goods. And sure enough, I got very confident when they started burning LeBron James jerseys in the streets of Hong Kong. I remember in October, there was some tension between the National Basketball Association and China after somebody in the NBA proposed via Twitter that we should support Hong Kong. And the Hong Kong protesters got mad when LeBron James didn't agree with the first guy, and they started burning LeBron James jerseys. And I thought to myself, you know what? It can't get any worse than this. As a Warren Buffett groupie, I always recall what he says is you pay a high price for a cheery consensus. And I thought back about these 2 years that I had gone through where there was nothing even close to a cheery consensus. In fact, it was doom and gloom. You had a full-out economic war started between us and the second largest economy in the world. As part of that, the president of the United States had said he was going to delist Alibaba and half of the companies that are in EMQQ. Throughout last year, you had hundreds of thousands of people in the streets of China/Hong Kong in violent civil unrest. Some of those people were beating policemen with metal poles. Several of those people were shot. It's on film. You could see it on TV. There was literally blood in the streets. And I thought, you know what? It couldn't get any worse than this. Now they're burning LeBron James jerseys. And as it turns out, I was obviously wrong. Well, we went on a very strong tear. Now we have the ultimate black swan. I won't speak to this in too much detail. These were my notes I put together for a TV spot I did 2.5 weeks ago, and it struck me that based on what the people at Harvard and Yale were saying up in the bold above, that this was going to be a big deal, and that it really was the ultimate black swan. I didn't see any Barron's forecasts in December that we were going to have this, and expect some volatility, and indeed we've gotten it. Fundamental impact on this story, in a lot of ways, it's turned the story on to steroids in food delivery, talking over the video conferencing. All of our Chinese friends have reported that most of their business went on to Tencent or Alibaba and their systems like the one we're on right here. Other companies like the travel companies perhaps got hurt. Overall, though, definitely a hit for global GDP. This is what I said 2.5 weeks ago. Now it's here, and my feeling is we didn't react was pretty clear that he had to get everyone to stop gathering. And now myself and the rest of Northern California has been forced to do this. Meanwhile, in Florida, this happened on Sunday. And yeah, I don't know what's going to happen with our situation here. These are my notes I made for this week. We were slow to react. I'm not sure how much flattening we've done. I think we're still just getting started in terms of this being in our lives, like knowing people at the hospital and so forth. And I can tell you that as someone that has been in sheltering in place, all of the things that are the U.S. version of the EMQQ businesses are now things that are much more part of my life, including Amazon and Netflix and the social networks, and all my questions are still answered by Google. And I'm also very concerned that we haven't reacted very good, but there's big populations around the world that I think are not in very good position to deal with this. India, of course, being the largest population that hasn't really seen the effects yet. So that's the end of my presentation. The valuations right now, I think, are very compelling. Our forecasts for the 2020 growth are coming together. They're low right now for sure, lower. But I think that the sell-off has created, very attractive valuations. And if things normalize, I think that the entry points that are available presently, if you've got an appropriate time frame, which is 3 or 5 years, I think. Not to say that these things can't go a lot lower, and the sentiment in the U.S. can't get a lot worse. But if you believe in buying fear, I think it would be hard to find a period of time in our lifetime where fear has been more strong. And I can say personally, I have never been as scared as the last couple of weeks. So that's the end of my presentation. I see at least one question. I think you can enter questions on what's on the lower right side of my screen. The only question I see is, what about the impact of further dollar strengthening over the coming months? I don't really I don't concern myself with currencies. It's out of my strong suit, and I've never had an opinion about currencies. Obviously, historically, stronger U.S. dollars are considered bad for emerging markets. China is the majority of the EMQQ story, and their currency is obviously, relative to most, fairly stable and relatively easy for the Chinese government to control. Other than that, I can't really add much in terms of currency. And I think that's the only question I see here in the box. So I guess I would just wrap up by saying thank you, everybody, for attending. And we will be happy to answer any follow-up questions. You can easily get in touch with us. My colleague's email is here. Oh, wait, I'm seeing some questions. Let me see if I can get this right. Okay, I apologize. Here's some questions. Can you tell us how you think the consuming class thesis changes given the current economic situation? It changes very badly, except perhaps in China. I mean, there are a lot of reports out today and the last few days that China's going back to work. They're going back shopping. They've made lists of things they want to buy when they get out. They're calling it revenge spending. So at least from the people we talk to on the ground, and at least the reports, China seems to have gotten their coronavirus cases under control, at least for now, and people are returning to normal economic activity. That is the most important geography for EMQQ. We do have exposure to India and Brazil and Nigeria and Russia and other places. And I think it's TBD. And I think, as I said, I think India is the place that I'm most concerned about. Second question is, how has EMQQ been affected or impacted by the gaps up and down in the market? Has it tracked the index well? One of the benefits of EMQQ is most of the companies are trading in the United States. And so they're actually open. The stocks are trading at the same time that the ETF is. And that's a benefit. They're also quite liquid stocks. I mean, Alibaba, for example, is one of the largest companies in the world. So it's tracked pretty well, and it's also outperformed. I mean, I'm talking about performance, but for the 5 years ended 12/31, EMQQ, according to the ETF database, had the single best track record of any emerging markets ETF for the 1 year period, the 3 year period, and the 5 year period. Now this year, of course, we're down a lot. But we're not down as much as the broad EM, and I think we're actually not down as much as the S&P 500, but we're definitely down. But the trading hasn't been a problem, and it never really should be. We have very liquid stocks, and that's all that really matters. So the other question, as people say that the emerging market growth is essentially getting slower, do you see a shift of your asset allocation? The allocation that we have this is a rules-based index. So, if you're publicly traded and you're an internet company in the developing world, we'll own you. Right now, that's about 2/3 China and likely to continue there. So I don't think, we wouldn't manually try to shift our allocation based on any such factors. Next question, could I elaborate a bit on Alipay and WeChat Pay? Will these catch on more in America or vice versa? Alipay's here, and but I'm not optimistic that any of these Chinese companies or really any of these international companies will have a lot of success in penetrating the U.S. market. I don't expect Alibaba to meaningfully compete with Amazon, but they do a decent amount of B2B business. There's a lot of small businesses in the United States that rely on Alibaba, and the only Chinese internet company that I think really has made inroads here is a private company called ByteDance, which owns the TikTok app, formerly called Musical.ly. And if you have teenage daughters like me, you know all about that. But other than that, I've never thought there was a lot of opportunity for these companies to really do stuff here in the U.S. So I think, why don't I say thank you to everybody that's dialed in, and we will conclude the call. Thanks again to the staff there at the CFA Society of Minnesota, and we look forward to doing any follow-up that any of you require. Thanks very much for attending our presentation. Bye-bye.